Hey everybody, welcome to day 8. Today we're going to go through some examples of gappers, probably the last couple days of the gap list, just to show you some examples of that and how that position management works. And then after that, we'll cover options. It's pretty simple. There is no slides I have created for this. If I have time this weekend, I will throw some together, but just an FYI, there is not going to be a slideshow for today. So you're just going to have to use the replay. And with all the questions that I imagine we'll have, I will do my best to read those out loud first. If I do not read it out loud and answer it, make sure to let me know so I can fix that. That being said, though, how is everybody doing? Good. Glad to hear it. I wish I knew how to say your name, Vladut. How's the how's it being a dad? Yeah, tired, I imagine. Doing great, seeing compound threes and ones everywhere. Good, good. That's awesome. All right. So we're going to get started. We're just going to talk about gaps, and we suggest the 30-60. So today, there's a few examples, not many good examples of trades, simply because it was pretty low volatility today. Now, with what we know to be true and what we've talked about so far, how can we expect a lower volatility day? That is something we can talk about here as well. So you can see Dow Jones does start as a gap down buy, right? So they gap down after yesterday closes here. They make the gap lower, take out lows. So they're going into what? Exhaustion risk down at these lows, bottom of the daily try. And then they do turn into a buy. If we go to Qs on the day, Qs was a 2 to the upside. It spent a lot of the morning inside day doing nothing. If we go to SPY, SPY sent all day as a 1. We go to IDBM. IDBM finished the gap up sell 2-2-day magnitude we mentioned yesterday morning. Or not yesterday, but yesterday morning. Sorry. So 2-2-day hits its magnitude, hitting the other side of the try, which actually did create the shooter week, momentum shooter 3-2 down for the 2 down continuation of the 3 expansion, which could take the month inside down continuation, pivot machine gun through these guys with the clustered tight pivots. And that could be a big problem. So this is something we definitely want to know about going into next week. But as far as low volatility or how you can expect kind of a lackluster trading day, well, SPY's a 1. So we already have a fourth of the indexes inside. IDBM's 2 down in red, going lower. And then Qs was inside in the morning, most of it. So you had Qs and SPY, which is half of the indexes inside to start the morning. And then Dow Jones is 2 down in green. So when you have half of them in trading inside bar, and then one of them going down and one failing to go down and going up, you're not confirming everything across all 4 of these indexes. Whereas when you have all of the indexes confirming, or at least like 2 or 3 of them confirming the direction, with 2s near the daily open, you'll get that trend. So, for example, we can see Qs and SPY. This was Tuesday. SPY had the 2 going 3 day. Qs had the 3-2-2 day to the upside. And then here, IDBM was a 2 going 3 to the upside. And it looks like Dow Jones was a 2 down in red to start the morning, but recovered off the 60-30s. So at that point, we at least had the signal enforced Qs and the signal enforced SPY, both signaling higher. And then this was a 2 going 3 confirming that. And then Dow Jones went in last as the Whoa. Sorry, I have no clue. My phone just randomly started playing something. But Dow Jones was the laggard. So you had 3 of them confirming 2 and 2 going 3 to the upside, and then this one came in late. So you get a better volatility or better directional movement on that type of day in comparison to where you have many conflicting 2s as well as a lot of 1s. So that's how we can at least expect that. And you can see it's just closing 1 on SPY. So into next week, the question would be, which side of this do we take out? And we did not stream today, but going into the gappers, we talked about them briefly yesterday, the 30-60s. We have Elaine posting them in the morning. She does not post every single gapper, but she normally tries to stick to ones that have news. And then if they don't have news, that is something she will also put in there if it's just randomly gapping for seemingly no reason. But that being said, We can start with Adobe. So when we're doing our gap analysis, we do want to have ideally the day, the week, the month, 60 and the 30s all up, or at the very least the day, the 60 and 30, because the daily continuity is what is most relevant to us. So we can throw the 30 up here, we can throw the 60 up here, and we have the day. Make sure these are all linked together. So what you can see in Adobe is it is back through previous range, has the week enforced to the upside. On the daily, big gap into nothing. So when this occurs, you have no nearby pivots to take out, right? So it's going to be totally dependent on how aggressive is that daily participant. So depending on how bright green or bright red that bar is, that tells you how aggressive they are, which is why the continuity is one of those universal truths. The relation to that open, how much continuity do you actually have? So you can see, just like yesterday, complete doji doing nothing, that was what it was doing today. So if we go in there in the 30s, this is mother bar. And remember, towards the beginning of the course, we wanted you to be able to identify when you're stuck inside a previous range like this. And if they're not moving into the morning and they just start going like this, we don't even want to mess around in there. Until it takes high day or low day out, that's nothing for us because that's still a 1 all day. And you can see they go double inside 60. They attempt 2 to the upside, which you potentially could have taken. But when it starts coming back into that 1, you just have to get out. Tight stop. There's nothing you can do about that. Could you have flipped short for the rev strat as well? Yeah, you could try that, but it also takes both sides of this out and then starts coming back in. You have to get out of that short. There's nothing you can do. So not much happening on Adobe today. Shopify, beautiful. This is exactly what we want to see. So you'll see in the morning, no 60 actionable signal, no reversals or anything. What we do have is the day 222 in force. It's not a kicking pattern, but what we would say is that anyone short yesterday does have some problems. So it's similar, it's just not what we're looking for specifically. If we're looking on the week, back into this weekly 3, so we can gauge the magnitude up here. So you have reason to believe that can go higher. You also have full time from continuity to the upside. They go inside 30, inside 30. So like we had talked about with mushing candles together, we can also identify this as a sideways 60 because these two 30s are 60 minutes inside of this. So you have an inside 60. Now, this is continuation. So this is a very aggressive entry strategy because you're buying into recent highs. So if you take the offer at $66.99, your stop is here, $66.83. Your target is high a day. Once it hits high a day, if that starts coming back in, you have to defend and exit your position. In this case, they close higher. Then you get the momentum 30 if you wanted to add into high day, which again, pretty risky to do that, but you have a winning position. It's their money. You can risk what you'd like. Then they go 2, 2, 2, shooter, 2 up, 2 down reversal. This is where you'd reduce your position or exit. And when we say reduce, it's like maybe take, let's say 100 shares here, take 50 off here. And then if it stops you out break even, so be it. You already made your money. And then here on the 30, an additional 30 setup here. Hammer 30, you can get back in right there. Above 67.18. And you can see with the hammers, we want a very tight stop on that. 67.1, 8 cents. Then they go, and then into the close, you either exit or depending on what you're doing, you could technically hold that into the weekend, preferring not to do that because the weekly, daily, and 60 continuity will reset next week. So you can see they trade up. There is the 30 in here, either reduce, exit. You can flip short as well, 30 minutes, and it does work a bit, and then flip back along, get back in. If we go to Zscaler, this opens as a 1 on the day. No thanks, right? It's trading an inside bar. Heck no. And you also get the mother bar 60. Notice all these bars stuck inside of this. If you're a gapper trader, this is what you need to avoid. If your stock inside bar breaks lower and does not go anywhere, you have to get out. There's no sticking around there. It needs to just go. If we go to RH, gapping down. So you can see on the down gap, gaps into exhaustion risk, but they're nowhere near reclaiming these lows. So we need to reclaim this stuff if we're going to attempt to try and come back through all these guys. We go in the week, also gapping down into exhaustion risk. So at that point, we don't know if the sellers are going to keep coming or bringing it through. In the morning, there is the 30 shooter momentum candle, which is a very aggressive strategy because it's continuation into low a day, which you could try. Goes down for 30 minutes, goes inside in green from exhaustion risk, and then inside bar up reversal, you just have to cover. There's no sticking around. When it goes rev strat, you could attempt that again, but you can see it breaks lower, and then break even gets you out, and now it's mother bar. all this action starts getting stuck inside of this. So not much good action in there. And then if you're a 60 guy, you can see the same thing, mother bar. So all the gappers today, kind of just slow, which will happen. We can keep going through the list though, we'll see. So NVAX, you'll see gap down sell. There's no signals in here to get long or short. And then here, inside 30 actionable signal. It is red on the day, but that's a 2-on-2 reversal right there. 1375, you can take that. 2, 2, 2, 1, 2, add to the position. Because if a trade works out and you get an add, you can do that there as well. 2, 2, 3. So maybe you reduce that add, still leaving this one in here, or reduce by half, whatever you're looking to do. And then 3, 1, 2, you can add back in with more. And then you'll see they go into high a day, which is your daily or 60, 30 short-term exhaustion risk. They go up and they keep going. That's good. Once it flips red in here, you have to start defending your position, either reducing by half or exiting the full thing at that exhaustion risk. So still very decent trade, very simple. On a 60 basis, you get the 2, 1, 2 reversal. And this is tricky because it does go up, pulls back in, goes shooter, does not trigger the shooter. So if you're a 60 guy, depending on how you manage that, if you have the stop towards the low of the 60 or as a reversal against, or if you have your stop nice and tight in there, potentially either stop out or you don't. That being said though, the 30 does get you back in that right here. So using both the 30 and the 60, you have the 30s in here to create. You could attempt to add and then you have to reduce again, right? When that 60 starts coming back in, but then you can add back on this 30 and on this one. If we go to NUE, this is a great example of the gap down buy. So on the daily, going into daily short-term exhaustion, also going into weekly exhaustion risk. And it's because you're just going into recent lows. On the month, you get monthly exhaustion here, which we're not back above, so there's no exhaustion there. So just on the week and the day. You'll see in the morning, the 3, 1, 1 hammer. What do you know what to do there? Well, right here. 150, 357. What does that create negator do on the higher time frames? It also does the 3 on 260. So you can take it here and here. And then at that point, it is an outside day. So you have to be aware of that. Once it's in the high date, it's got to stay up and out of these guys. 154.76. Then you'll see they go 2, hammer. They did retrace a little bit, still staying above the highs. 2, 2, and then 2 to reversal at the end of the day to close. So nothing too crazy in here, but very nice position off the 30s. There was the inside 30 add into highs, which would have stopped you out. If we go to the end of the day, there is the 30 doji in here. Not an actionable signal, but if it was like a shooter, we could have even tried to flip short with their money. If you go to pins, you'll see similar in pins. 3, 1. It does break 2 down, fails and goes green. That's a potential rev strat. They do make the highs. Then they go inside bar. Then they go 32 down, 2 up. They don't really do much. You can see would have stopped you out. They do create another 30 signal, which does get it going a little bit up in here. But what we'll see is they were too weak to become the outside day. On a 60 basis, they went 3-2 continuation and then inside continuation, which does work for a bit, and then 2-260 against. So what I want you to see here is the gappers. When we take this 60 or any of these signals in here that we can create a position on, we want it break even. And then the ones that really do get going, because you'll have days where these gappers go nuts, and we'll show you some of those. The ones that really get going are the ones that you'll make the money on. It's not these ones where they're not really doing too much. Because if we go to something like this, and give me 1 second here. Williams-Sonoma. So notice the gap up sell right when that goes red on the day for the potential 1-3 rev strat with a magnitude here. So you can gauge that on the daily before the open. You can say, well, if it's gap sell, that's the magnitude and it's really big. What you can also see is it's coming from exhaustion risk going into the highs there. And on the week, your try looks like this, which we'd also see on the daily if we zoomed it out. So when you get the ones that keep going, this is where you make your money. And this is what we mean when the gappers, we say some days are bad. Yeah, you're going to stop out. Other days, you'll take it and it will not reverse. So in the morning, they go 2 up red 60. If you're a 60 guy, right there, 324.34. And then they drop $50 into the lows. And then you can see, in this case, they had no reversal until at the close. So you'd short here and then come in at the end of the day, cover. And that'd be your trade. What we can also do is go on the 30. You'll see the 2-2 reversal 30 here, short. So you have the 30 and then the 60 here to add to it, and then down they go. There's also the inside 30 in here for a potential add towards the lows, which doesn't give you too much because it's right at the close, but still, you'll see exactly what we're talking about here. And these actually happen more often than you'd think. Maybe not $60 in one day on every single one, but when you get the gap up and the institutions come in here and use it to sell, this is what it looks like. So we want you to be trading these gaps looking for stuff like this, where you can get the big old 3, and ideally with that inside bar before, because then you got the rev strat to go after as well. And what we mean when we say that is once you reclaim this inside day, that rev strat goes in force below 316.84. You can short there as well. So you can have the 30, the 60, and then the rev strat day as well, all 3 in the morning. And some people will choose to just go in, and if they can create the position in here, put it break even, come back at the end of the day and close it. And that's perfectly fine, because sometimes you'll have it, it'll drop and then chop around. You might stop yourself out and then it'll keep going. So depending on the type of person, you'll manage that differently. But that's the type of stuff we were trying to get you guys on. So if you follow the rules, hold things that do not reverse against you, keep your break even stops, this is the stuff you can catch. And there's let me go in here. I missed a few from today. STLA. You see, this is another example of just gapping into lows, and then they do pretty much nothing. You have a 60 hammer in here, create the position, 2014, but inside 60 up, comes up, and then fails, and you just have to get out of all of that plus the add. So nothing much going on in there. If we go down in the 30s, all 2s to the downside continuation, double inside 30 here to create the position with the 60, and that works. And you get the 2-2 against here to reduce by half, and then into the close, nothing happens. So you can see you create the position, and then if they're really going to get moving, like the example of WSM, you're in there. Not all the ways do they do that, but when they do, they're big. Tesla was an example from yesterday. So this is why we say gap ups are made for selling. Tesla on the daily. What you can see is they're gapping into daily exhaustion risk. That's a gap up sell once it reclaims that stuff. And also last month's highs, 187.56, became an outside month and an outside week on the gap up. On the 30, there was no good 30 signals in here. You'll see there was a 2-2 30 in here. Then they go 1 and against. It's going to stop you out. Into the close, there was the inside 30, which does work. You can see for the last hour of the day, but that was it. At exhaustion risk, once they take out low a day and start coming back in here, you have to cover. So small trades. If we're a 15er guy and we are proficient at the gappers and can drop time frames, you can get more signals. So in this example, you'll see continuations into the highs. We do not buy that. And then 2-2 reversal 15 here, 187.44. We can short that, and you can see the stop goes there. You target low a day, and it stays below, so you can stay short. And that's an example of you get the short in the morning. If you come back at the end of the day to cover, right here. So we can then also go to, we're going to tomorrow's or yesterday's gap list. Billy. An example of your mother bar problems. So they go in here, mother bar, and then you get a rev strat. So this is something we already talked about a bit, but when we go inside of the previous range, looking for that broadening formation to form. So since we know the 1-2-2's magnitude is to go compound 3 of the 1 and the mother bar ideally, when this 1-2-2 occurs, you can gauge the magnitude and say, okay, we're going to try and take these guys out. So you can either decide, I'm not going to trade this because it's mother bar, perfectly fine. If you're not comfortable with it, fine. Or you can say that's a rev strat actionable signal here, 1509, and then takes out low day exhaustion risk. They do come back up, so you're going to have to reduce by half. Then they go 2-2 here, where you'd either flip long and cover it all, or just cover it all, get out. And they have the 1. They did try and break down at low day. This is a more aggressive entry because it's continuation into low day. Whereas this, you can see, is reversal back through previous range. So we prefer not to enter on these. We only prefer to add on these. And if we go to the 60, you'll see the 60 goes 2-1, and then 2 countering the color of this 60. So although it's a 2 down, 1, 2 down, we can say it's reversing these guys. who tried to buy in the morning. So below that, 1493, which is triggered by the 30 rev strat on the flip, takes out low a day, and then inside 60 up, cover. So hopefully you guys can see how that's working. NVIDIA, I believe this was a gap up yesterday, and you'll see, you got to be very careful of that mother bar. So they go stuck, 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 212 shooter reversal here, which you could have tried short into low a day. Now that's exhaustion risk, 127.39. So it starts reclaiming that and then flips the color here. You either flip your position to long for the rev strat or you're out, right? And then the 12260 rev strat here, you can create a position here. Does what it's supposed to, taking out high a day. Took 3 hours to do it though. And then that was that. So not much action on the video, and you can see just small ranges in there. If we go to ANET, this is an example of the mother bar, but you'll see this. So they go 1-2 up, it attempts and then comes back in. So maybe that signal doesn't work, you don't get a piece of that, that's fine. They go 2-1-2 right here. You can attempt to take that to get you out of this mother bar because you're now closer to taking out the highs here. And then once it does that, you're at that short-term exhaustion risk of high day, and they close out at the highs, so you'd be exiting at the close. If we go to the 30s, there's a double inside 30 up here, which fails. Make the winning position, it reverses break even on you, so be it. Then you get the 1-2-2 rev strat here on the 30 above that. And notice how your stop can be extremely tight on the rev strat. When that has full time frame continuity, where every time frame's green and the rev strat occurs, there's zero reason to believe that's not going to work, especially when it's going to trigger that 60. So the 30 here above 326.29, risking like probably this spread, I'm not sure on this, but risking probably 20 cents here. Also triggers the 60 for 2 positions into that to make high day. If we go to play. So in play in here, you'll see it was a gap down, and this is yesterday's price action. So on the earnings, gap down. This is continuation to the lows, no shorts. There was the 2230s back up, which more than likely is either going to stop you out break even, depending on how tight your stop is. Either that, or you held into it because you're risking the low of this candle or reversal against you. Then there's the inside 30 up, which does work. The inside 30 up attempt to add to that. Then it goes 2-2 shooter 30, flip short. Because at that point, you have pivot machine gun 30 the other way. They tried to attempt that negation of the day and take a high day. They were too weak to do so right here. And then on the 60, there was the 2-1-2, and you can see mother bar. They're trying to get up there, but it goes 2 and then red right here. 2 up, red, failing. You have to get out on that. And that's also occurring with that 30 shooter here. And then they go 2 down, 2 down, 2 down, 2 down. And then this was the close. 2 down in green, you'd reduce by half or cover. And this is where you can see on the 60, mother bar to this stuff. So the range is just very small. Ideally, when this is going inside still in the afternoon like this, we're not even trading that stuff. But you can do that. And since we know when you're inside the morning range, it attempts to grow, or when you're stuck inside, it attempts to grow. You can see they make the new highs to the 1, fail back into the 1. They're trying to take this out. They just ran out of time. They came in and did that this morning. If we go to SIG, you'll see the 2-1-2 reversal into the mother bar though. So nowhere near taking out high day. So if you tried that, when it flips red, you either have to flip and become a short trader or be completely out if you tried the long. And then the 1-2-2 rev strat here on the 30 takes out all these guys, as it should, low a day. Then you do get exhaustion risk. We're going to see it pokes down. It does open the new 30 here, poke down again, and then starts coming back in to the previous 30s range. That's where you'd start reducing by half, either down in this stuff when it starts coming back in above previous low day, or when it pokes down here and then starts coming back in. There is the hammer 30 back up, which you could either close your position on, or you could try and flip long, which in this case, that does not work. Countered by shooter, 2-2 reversal. If we go to the 60, you're also going to see the 2-2-60 that occurred in here off the 30 break. And they go 2 down, 2 down, 2 down, low a day exhaustion risk, 1, 2 reversal, either flip long or cover. And that was at low, that was at the close. Jill on a share offering, mother bar. We're not even going to talk about it. UNG was not quite a gapper. It was a slight gap lower, but I wouldn't consider that gapper. Doesn't mean you can't trade it, but it looks like it was just going down on some like natural gas overnight movement. So prefer stuff with news and earnings, kicking patterns, that type of fun stuff. But you'll see they go what 2-2-30s, which fails, 2 going 3. And I imagine in here on the 15 you'll see this. So it's 3-2 continuation 15, which is not preferred. So no good signals in there as far as getting that short in the morning, which is fine. Then the inside 30 up, which you could attempt long, takes out its 30 magnitude, comes back into that. You have to reduce by half or get out. And then you can see, looks like slight poke down back in, so nothing there. If we go into the 60s, they have the 2-1-2, which does not work, and then rev strats. And then into the close, they're still stuck in that morning range. So they're too weak of sellers to get out of any of that stuff. And again, when this is starting to chop around inside of that morning range, that's when we start ignoring this. We want stuff that's at the lows, at the highs, or has the magnitude to actually get out of that. In this case, the rev strat 60 did occur, did confirm, but knowing you're taking this out into the close. And we want stuff with earnings. And it looks like, there's some silver stuff and all that jazz. This is all yesterday, but not moving on news. They're just 2 days to the downside. So in the morning, they go 2-2, take out the daily exhaustion. And you can see in the morning, it's just continuation. There's the 2 going 3, which is a potential short signal, but you got to be very quick. And then just into lows, 2-2-30s against. That'd be the only signal in there. If we go on the 60s, you can see trends down for the first 3 hours. 2-2 reversal, it's not actionable. And then 1-1 stuck. All these bars stuck inside of this morning range. And it looks like there's just a ton of gold stocks on that list, so most of them are going to look very similar. You can see JNUG, for example, they did have the 1-2 up red rev strat, either flip short or exit and attempt higher, which does 3 and then 2 continuation expansion, and then the hammer to either cover or flip long at the lows. So a little bit better stuff in there. If you go on the 60, you're going to see 1-3-2 continuation, which is not something we want you guys doing, although it is a potential gapper setup. But what we prefer is for the 3-2s, we want it to gap down, turn into a 3, and then 2 back through the previous range, or vice versa on the gap ups. So 3-2 into the lows, it's very aggressive entry, risky setup. We'll go to the next day. Oracle. So in Oracle, you can see the trade up initially, 2-2-30s down, which you could take short, 30 minutes, that works. Then it goes inside in green, where you'd have to reduce by half or at least have a break-even stop. Then you go inside up, you'd have to either flip long or just cover, ideally flip long, since you have daily continuity with you. We're looking for that high a day, which you can see they go 2 up red. Still not at high day exhaustion though. 1-1-2, which is continuation. Does pull back in, so you'd have to reduce. Then inside up again, and that's right at the close. On the 60, it goes 2-1-2 continuation. So it's a directional move where it's confirming this, which is not preferred. We want the reversal, not directional move, ideally. But you can see that 60 goes 2-2-2-2-2 all day into the close. So nothing crazy. It's a gap up buy, which is, again, not what we're looking for. But some movement in there. And then TSM, you can see in mother bar problems 3, and then stuck inside the 3 all day. So no thanks. Go to CIEN. CIEN, this was on 612. So you can see it's a gap up. It is back into a previous range. On the gap up, they go 2-1-2-30s down right here. 4808, which you can take short, targeting low a day. Then they go inside, and then down, add, makes new low a day. Once it starts coming back in, you have to reduce by half as that starts coming back in because you're at exhaustion risk. And then they go 2-2 here, which is a rev strat 30, either cover it all or attempt to flip long, which does not work. And then if we go to the 60s, you get the inside 60. 1 does break lower, momentum continuation, which again, we prefer not to enter and create positions on continuations because of this. Anyone short in the morning is getting what they want. It's continuing. Once it flips green here, now those guys are not getting what they want. They have to short cover, which is what you can see occurs up in here. And it looks like there's some news or something that came out intraday. If we go in here, yeah, so you can see 1230. So they do break it up initially. Then they became a 3 on the 60. So once a 3, always a 3. And what that means is all of this action here, what you're going to see is that this 60 became a 3 of that. And then it became the 3, went inside 5, up reversal, back to the top of the 3, and then expanded it. So it actually broke and then re-broke to put a rev strat in force above 47.89. So a little bit of trickiness in there, which is why, again, we want you guys to learn with shares, get very good at seeing this stuff and being willing to re-enter, because once you can identify your signals, if you know what you're looking for, you should be willing to re-break that and take that again if it works. Because when this 1-3 occurs, that 3 on the lower time frame shows you aggression, right? So you have aggressive buyers and sellers in here. The buyers won because that rev strat went in force again above 47.89. Then they went 3, 2 up. Does come back in red below this, where you'd reduce by half, leaving a break-even stop, and then 2 up, high a day, and that actually occurs the next day. So what you'd see is, or actually no, right here, high day right at the close to exit, 48.78. If we go to Affirm. So Affirm was a gap up in here. So you can see this is why exhaustion risk and the broad information is so important. This is also the gapper universe getting you onto things that are moving. So when the market's grinding up at all-time highs, what you're going to see is on the day it gaps, it creates the shooter. That means you can come in the next day, and since you know what a 2-2 reversal is from trading the 60-30 gappers, you can then trade it on the daily, because this is still a part of the gapper universe. It's just the second day. And we actually do suggest when you see things like this set up, actionable signals on gaps, look at it, right? Keep that on your list, because that's how you can start getting used to trading the daily signals as well. The other thing is, a lot of times on gaps, when you have, like, for example, Adobe, when you have this big gap up, what normally happens is they're going to have to figure out what they're going to do with this gap. So they'll either form an inside bar, or they'll attempt some 2s back down or 2s up again. But given it reverses up or down, or sets up the inside bar, you will have actionable signals. So this gap's obviously some pretty good news from the looks of it. The question is does that follow through, or are we coming back into that gap? As far as we see on the week, it could become a 1 next week, so we'll see. But watching them more than just the day it gaps, especially when they're setting up signals like this, is also important. And we'll expand our universe into the daily signals as well. So on the day it gaps, there's the 21260 here, which does make low a day and does not continue. So you'd reduce by half once it starts coming back in, stop at break even, so be it. What we'll then see is it goes 2-2 rev strat 60, soft rev strat, since this is not an actionable signal here. That does not work either, so they're chopping them up. Then they go 1, then they break the inside up, and then they go 3. So this is just choppy. This is going to be very difficult. And that's why we want the tight stops, because once that starts happening, if you're sitting there and you're widening your stop, you're putting it at low a day or really getting them big, you'll take it, take the L, take it, take the L, and you're going to get killed. We do not want that to happen. But then you can see the next day, given that the shooter day is occurring, and what you'll see is this was a doji all in the afternoon, which gives you the hint that the sellers in here, not that aggressive because of that doji. Neither the buyers, because the day was doing nothing. The next day, 3, rev strat. So they go green, red, rev strat below this, 3596. They make low a day. Then they go 3-1, 2 down continuation. And then 1-1, 2 down continuation. So you can see, let's say you get this, you get to add on this, which means your cost basis is still up in here. Inside 60, you get to add on that too. So when things do begin working, this is where you have to do what you're supposed to do, which is why keep the tight stops. Once they start working and you have a winning position, keep it even. Look for the inside bar adds as you get them. And in this case, you create the position from the top of the daily try, which works below 35.5 and any additional signals. And then the 2-1-2 again, add. So you can see how there's many different entries once things do start get moving. And then down here, inside 60 up, that'd be your first cover. If you're thinking of it, if you're waiting for next week because you set up a shooter week, you can leave your position, right? It's a winning position. And at that point, your cost basis would still be up in here. Because if you shorted in this, added in this, added in this, your cost basis would be somewhere up in here. And if you added down here, your cost basis would still be somewhere right around up in here. So adding to winning positions, super important with the gaps. And that second day, third day, and keep watching it. Zim is a 1, so there's nothing going on. Pets. So pets, you can see in the morning they did attempt higher. That gap down. There's no 30 or 60 signals. And then notice the mother bar. Everything stuck inside this first bar, ignore. Nothing to do. Hara. So this was a gapper inside day, nothing to do. But when it goes 3 on 2 here, you get to hit it there, 1068, which occurs well after the gap. You can also see an example of the kicking pattern on the 60. Bright green into the close right here, 2-2 kicking variation, and that's what triggers the takedown. It's not a gapper name though. And we could continually just keep going through this stuff. There's a ton. So let's see LLY. LLY, you can see the mother bar problems. Get stuck in this, doing nothing. 3, 1, 1, 3, 2, which expands it, but still just all stuck in that. So there's nothing to do in that. Now, let's say you're a quicker. Oh, you have questions? Oh, sorry, Sarah, I didn't even notice. A kicking pattern is okay. So let's see. That PDF does not exist anymore. I was asked about a PDF. I made it on my YouTube channel. Do not have it anymore. Still confused on what a kicking pattern is. It is as it was depicted. I don't know why. Like, you need to explain. Please tell me. Why is it so confusing? Because everyone gets so confused, and I don't see it. You're kicking people out of positions that they were in. So closes out, opens at the highs, closes at the lows. When this gap's here, these guys get kicked out because they're short, and it's occurring at the bottom of a downtrend. So anyone that was short previously also goes to cover here. And what's also occurring is, since it was going down before, no one could be long this, right? So all the longs are sidelined. So when this opens up and is green, the longs can now get in. So you're simultaneously having longs first entering the market that were all sidelined, and every single short position from yesterday and any of these short positions in here starting to cover by taking the offer. So you get every participant, both the sellers and the buyers, taking the offer to the upside, and then vice versa to the downside, like this. Notice people get short, gap against, boom, kicking pattern. Vice versa. People, this is wrong. That's funny. Notice people get long, gap against, kicking pattern. And this stop loss entry crap, don't look at that. That's wrong. Your stop loss goes at the high of the candle you're trading or the low of it if it's bullish. Like, for example, when we go to para in here, anyone that bought yesterday at the close on this 30, when this morning goes in force, 3-2 reversal here, there's no reason that shouldn't puke. Because everyone that was long is getting cremated right now. Below that, 1095. They all have to get out. And simultaneously, anyone that was buying yesterday also sees that and they want to get out too. So everyone hits the offer at the open, including the buyers and the sellers. So it's extremely directional and quick. For example, Marvel. Not a full kicking pattern, but it does gap against and then take the low out. So it's a similar concept, just not the full gap. They were long yesterday, 3, and then 3-2 reversal. Here, crater. And there's another example of this a while ago in Marvel back up in here, which we already had covered in the slides right here. They're long into the highs. Notice the uptrend. Everyone buying in that uptrend and yesterday starts selling here. These guys sell first, and then it triggers the rest of them. Boom. So if you're going to trade a gap and go, the question was playing gap down sells or gap up buys. You need to have, like we talked about yesterday, back through previous range. So if you're back through previous range, for example, donut's actually not the best example, but it does show what a gap up buy is and what we want to look for. So we'll do it anyways. So we ideally want it back through previous range. So like, let's say donut gapped up in here, like 13, 14. We'd want to take it all the way through that because we're back through previous range. If it's green on the day, if it's red, sellers are more aggressive. There is no buy. Now, as far as entering on gap ups go, we need to see red bars before we enter. We need corrective activity. So if we come in the afternoon here, after maybe we don't take this continuation, that's fine. That's a very aggressive entry here. Although it is actionable, right? So you can do that, create the position. Then you'd reduce by half if you did take that. And then inside down here. The day is still bright green at this point. So when this goes inside 30 pivot machine gun here, you take the offer at this 16, or it's like just below 16, like 15.98. You're buying the gap up, but the gap up's already green. So you already know buyers are more aggressive because it's still green. And you have a magnitude to take out high day. So you can create a winning position, let it take out the highs, break even your stop, and then 2, 2, 2, 2, 2 reversal either, and this actually occurs on the next day. So you just get out at the close. But this was actually something we were watching on the 15 in the morning down in here. So we can't enter on continuation up, or at least we don't want to create positions on continuation up. We want to enter on reversals. And let's try and get all the way back in here. Nope, this one was also continuation here. Forgive me, I think it was PDD. No, you do, Arcan? You flip short because you know what to do. So, okay, you lost your money overnight. That's fine. Get in short, make all your money back, and then some. Because the whole reason it works, the whole reason the kicking pattern works is because no one saw it coming. No clue. So even if you didn't see it coming, you know what to do next. So you cut your loss instantly because you don't hold losing positions, and then you get short, make all your money back, and then some. That's the thing about the strat is you keep the tight stops. Maybe you lose a little, lose a little, lose a little, make a lot. Whereas most people make a little, make a little, make a little, lose a lot because they don't know what to do when they lose, when they get in a losing position. Because everyone wants like 90% win rate and then they take a giant loss and erase all of it. We want the opposite. We're willing to take stop out position after stop out if we're doing it in our universe that we know has an edge, which the gappers do. And then once you get the one that starts going and keeps going, you hold it. So when it comes to mother bars, let's say what was an example of one? Adobe. When it comes to Adobe, I'd rather let them trade a little bit and figure out what they're going to do. Because at this point, your nearby range that you can take out is this. So you have like a $10 range to play with, which some people will do that. That's fine. But normally what you'll see with gaps is this. So you can see they go 2, then they do break the low, fail, come back in, and then 2-2 reversal back into the previous range, which you get to play some of that, right? Works. Then 2-2 against, and they start a new broadening formation because there's no nearby stops to take out. So when you see this go stuck completely inside, we also can call that like, that's an inside day. That's as close to an inside day as you're getting without being an inside day because it spent every hour of the day inside besides the first one. So should this go inside equilibrium break up or down the next day, you could look at it like this. This is your 1. So it'd either go 2, 1, 2 down or 2 up tomorrow. Now, if it goes 2 up, you'll still be a 1 on the day. If it goes inside down, you would be a 2-2 reversal day, so you at least have that. But what we would say is we're still not trading in the direction of the most twos. It's just the daily. So it'd be a day by day trade if you're doing something like that. And I hope I said that question out loud. The question was, if the candle is stuck inside a mother bar on the first day, would you trade on the second day if it gets out? Since there's still volatility. Yeah, Arcan, which stock did it happen to you on? Curious. I like gapping craps. Gravity helps. That's hilarious. SMCI, not a kicking pattern. It's a one on the day, so still good. But what you have to be aware of is next week the continuity changes. So depending on where that one breaks, weekly sellers might come in or the buyers come back again, depending on which side of that it goes. And that's why when it comes to overnight stuff personally, I know you grabbed it off the inside 15 here to trigger the day in the week, which is good because you want to trade continuations or inside bars in general to trigger things. You don't want to just trade them separately without looking at the higher time frames. So you did really good there. Now, once it's going all the way up in here, maybe you reduce by half when this stuff comes in, or you're just holding. That's fine. But come the close, I would reduce partial of that position or point a piece of that position, and then the rest you can leave free because let's say you make, and I know these contracts are huge, so let's say you buy two contracts, maybe it's $2,000 or something, maybe a little more than that. Up into this stuff, when it's up $80, those could be up $800 a piece. So if you spent 2,000, you take off one at, let's say it's at 1,800, you just pretty much paid for that position. So you don't have to do anything with it unless you're at a loss, and your cost basis is well below your entry. It's way down in here, if that makes sense. So on this second day, you can give it the room to do its thing and see, do they come back next week? NVIDIA on May 31 kicking pattern. It was a Friday. Are you talking about here? This is not a kicking pattern. The next day was, yeah, in here. The kicking pattern is only in force above the daily open though. So 113.62. And this is not a full kicking pattern. Notice the lower wick. What did the shorts at yesterday's close do? Covered. They did not stay short. The kicking pattern, the reason it works is because it went out on the lows. They stayed long, they stayed short. So in this case, they did not stay short. They covered their short position. And then anyone that stayed short, which some of them could have, right? Still closed red. They were the ones that had to get out. As far as the price action on that day, you can see you get a chop shop in here. There's a 2230 which hits its magnitude, and you have to reduce by half when this starts coming down on you, or you stop out even, right? And then they're chopping it up in the morning range. So what does the 60 look like? Yeah, so what, 2-2 does not work at all. Two down, two up, and you see they're just chopping it up in here. This is the stuff that once you can identify this day is a doji, we really just are not interested, at least as an intraday trader. If you're a swing trader, when that goes 2-2 day on NVIDIA here, 322, you can buy that, right? Until that reverses against, full time from continuity up. So depending on if you're intraday or swing, that'll change how you're managing your position, which is why everyone's going to manage their stuff differently. But as a swing trader, you get to buy that, and then 2-2 against, but you get to hold that, or reduce by half and then hold the rest. 2-2 back up, add back with more, and then up they go. So it depends on how or what you're doing. But that is not a kicking pattern. Big lower wick. Yes, absolutely. Because you got to think, right? And this is also something just understanding how the candles form. If this is bright red, they shorted, right? So what may they do at the close? They may close. So the same thing applies to like when you have bright green, bright red days or weeks. If the week is bright green, they've been buying all week, what may they do on Friday or Thursday at the close? They may start taking some of their profit, even if there's full time from continuity, because the first guys to normally sell are the guys taking profit. So like SPY today wasn't a good example of profit taking so much, but you can see they did take profit on Thursday. That's something we saw. Did not get back into any of this stuff, reclaiming this, so there's no issues if you're long into this stuff Tuesday, but on Thursday they definitely did some profit taking. And you can see, since it went 2 down, that's what tells us that. So I had a question about the Thinkorswim indicators. Type in the Strat Suite Think script. These here, posted by Pell and Sachs, and you'll get all the cool Strat stuff you want. And some of these were my requests that he actually did make. It was you can see you get the watch list columns, all that stuff. So I'll tell you what's going on. Broadening formations, which I wouldn't mess around with that. It's kind of a mess. You can scan for your actionable signals. You get all of it. I believe the one that I had made by him was these. So this type of stuff. Yeah, Alex's options. So this is a while ago. Yeah, this is 2020, so 4 years ago nearly. Indicators for TradingView? Yeah, just type in the Strat in the TradingView stuff and you'll find it. Apart from PDH, PDL, which is previous day high and previous day low, what other levels are important? The daily open is most important for gappers because that tells you how aggressive those guys are. So like if the day is bright green and you have a winning position and you get a 30 against, you don't have to close that. If you're in a winning position with a break even stop, you can stay in. Or let's say you get a signal that negates the day, like you get a Rev Strat 60 that changes daily continuity. That's how you know that there's potentially daily guys on the wrong side of the move and you really stick it to them. But the other thing we do with gaps is we're looking to see, did you negate anyone? So, for example, let me think of. So when Costco gaps and does this on the day, when that occurs matters, right? So this is Monday, Tuesday, Wednesday, Thursday. This occurs on Friday. So the weekly open is this. So when we trade below that, any weekly participant long this week is at an immediate loss because weekly continuity has changed here, 755.08, which increases your magnitude to a potential 3 on the week here to take this out, 739. So on the kicking pattern here, we can short that, also knowing that not only are the daily guys of yesterday really screwed, all the weekly guys are screwed. So that's a definite short that should drop. And it's on a Friday where everyone is more than likely going to close their long positions. So we're forcing them to do that. And you can see they start at the open and they do that all the way into the close. And then they get out of somewhere down here and then the 2-2 flip long. and then they get, you can see, stuck inside of these two bars, this stuff. Then you get the 3-2-2, then the 3-1-2, puke into the recent lows here. And then the 1-1-3-2 rev strat to recover. The 1 gap up 3. So this is your rev strat gap up sell, green to red right here, and triggers in this. You can see that's another broadening formation that forms. They get stuck inside of that stuff. And there's some 3-2 action, which expands, which you can see on the weekly, 3-1-2, back into this 3. So they reclaim this 3, take out both sides of it. The Strat scanner. The Strat scanner will show gappers, I believe. I'm not sure. It's not going to show us right now since it's closed. Market's closed. But it will show, it'll mention if it's a gapper. If you're scanning for gappers, the best resources are going to be Elaine, since she does most of that for you. Yeah, Arcan, that's called triangle day outs. We call it micro triangle day outs. When a signal triggers, might come back a little bit and then re-trigger. That means you're getting lower time frame, 5, 15, 30, 60 signals. Trying to think of the last kicking patterns we looked at. Yeah, there's a little bit of one on Upstart, which did work, hit its daily magnitude, but that was about it. Yeah. They don't come always, but when they do, they're fantastic. Our favorite one, what was it? It was Lowe's. This is from many years ago when we were trading when this Discord was first started. Right in here. This is textbook kicking pattern. So notice the broadening formation and then the kicker at the bottom of the try to time the entry back through previous range. So they make new lows after making new highs like this. Right here, 3-2-2 kicking pattern back through previous range. That is what we're looking for. If we could get this every day, this is what we do. It's like right when that goes green, 1, 8, 9, 19, we're long. Stop low a day. And this went, I think it was 2,400% in one day. And then you had the 2-1-2 add if you're going to try and send it to them. And you can see they go into the top of the try and then get out, 2 up a red, reduce, and then 2-2 exit or reduce by half. So they'll come. You just have to be patient to get those setups. Daku. Let's take a look. Yeah, so slight kicker, but definitely you can see 2-2 kicker. It's a variation because it did not take out the lows on the gap, but it opens, goes red, and then instantly takes out all of yesterday's guys and all 3 of these days here. So all 3. And it's back through previous range. So you have previous range to come back through. And you can target here. Notice right into it, 54.64. So these, Sarah prefers these because you can take it as a 2-2 reversal. 57 to 55. And you can see in here, how do you add to that? Well, you get short, inside 60 down, add. And then it's a winning position you hold. Make your whole entire week in one trade. Oh, you're talking about this, the big crapperoo in here on the 7th? Let's see. Yeah, this one. So this is the thing, though, is this kicker going into recent lows. It's not what we're looking for. We want the back through previous range. Because when you're back through previous range, then you can get the crater. Whereas this goes straight to exhaustion right at the open. So in the morning, I imagine there was some fivers and stuff in there, maybe a 3 minute for the quick guys. And that's the other thing with kickers. Ideal scenario is using the 1 minute and stuff to participate in there to reduce your risk on that, which you don't always get, which is why we prefer the green to red move as a continuity entry. Yeah, so options. So when it comes to options, there's a few ways that we look at this. A lot of people talk about delta, theta, all that stuff. We will not talk about that here. If you want to learn about the Greeks, you can go on YouTube. There's many videos that can explain them much better than I can. So just to get that out of the way. But when we're looking at options, let's say, for example, the XLU trade is actually really good. I don't know if we're going to be able to pick those up. I guess we'll do one that's already going now. So first we want to do our analysis. What do we know to be true at any point in time, right? So you can see in here, for example, T has the 3-2-2 on the week. So depending on how we want to trade this, if we're just in there this week, just trading this week, we would want to go at least a week further in expiration to give them enough time to actually complete it. You'll notice they ran out of time here, but if they don't reverse this next week, that's still going down here. The magnitude is still 1711, and that would trigger the PMG. So this is also something technically we could look at next week. But when this breaks at 17.9, our question is at what strike price will we have an intrinsic value when we take out 1711, if that is our magnitude? So I'm going to pull up a whiteboard so we can explain intrinsic value, and then we'll take a look at the options chain. So options 101. You're going to have calls and puts. And they both mean very similar things. So whenever you buy an option, you have one contract. Call or put. What this contract is giving you is the ability to buy or sell shares at the strike price. So you're going to have a strike on your contract always. And for example, let's say our strike is 100. So when we buy this option, we're getting the ability, if it's a call option, to buy 100 shares at $100. So that means the intrinsic value. And all this means is what it's actually worth. Is going to be however many dollars in the money this is. So what in the moneyness or moneyness is when it comes to options is if our strike is 100 and it's a call option, if price is trading above 100, it's in the money because those 100 shares at $100 are worth more when it's trading above 100. If price was trading at like 99, this would not be in the money because the strike is above what the price is currently trading at, and it's a call option, betting on higher. So when we buy this call option, what we want is an intrinsic value higher than what we had paid for, and that would be your break-even price. So let's say we bought this for $2. We bought the 100 strike call, and let's just say the stock is trading, when we buy this, the stock is trading at 100. So stock's trading at $100. We spend $2 on our option. It's a $100 strike. So in order for us to make money, we have to calculate our break even. And what our break even is going to be is how many dollars in the money does this strike need to go to get us above what we paid for it. So if the stock's at 100, our strike is 100, and we paid $2, our break even is 102. So it needs to move at least $2 to the upside for us to make any money. At least two. It's got to go 2.01 and you'd make a penny. And that occurs on expiration of the option, which most people don't take too much into account when they're looking at this. They want to buy really far out and just use the delta and the theta and calculate it that way. But since we're straters and we have an expectation of how long this may take to work, we can go, let's say, 2 weeks out on a weekly setup. And if, let's say, this option is trading much lower than it should be based on the magnitude of our weekly setup, what we can say is the intrinsic value will be much higher than what we pay at our magnitude. So, for example, it's trading at $100. We spend $2 on a call option. We have the $100 strike. Let's say we want an intrinsic value of $6. So we bought it at 2 and we want it to be worth 6. That means by the expiration of this option contract, we need to be trading at 106. So if our magnitude is, let's say, 108 or 110, and we can buy this for $2, that tells us this move is not priced in. And hopefully that makes sense. And if we go to the options chain, it will hopefully at least put it into perspective. But our break even is 102. If it's trading at 106, we'll have made $4 minimum. And this way of looking at it is really simplified. But when you're trading the strat and you have a magnitude, you know where it's going. What we then know is, let's say, instead of it trading at $2, let's say it's trading at 10. So if it's trading at 10, our break even goes from 102 to 110 to make any money when it expires on expiration. So in order for us to make money, it would have to go from 100 to 110 on the stock price. So let's say our magnitude's only 110. That means we're not going to make any money. It's priced in. They have a $10 payment to buy that. And if it goes to 110 like it should for the strat magnitude, it's priced in. If it expires on the day that it hits 110, you make no money. So it's not a good option to buy because it's pricing in the move. Where we can then really get after it is when we can find things that are not pricing in the move on the options chain. So for example, let's look at T. If this is going to 17.1, how much were the 18 puts trading here for, let's say, like 2 or 3 weeks out? So this week was the 14th. Next week is the 21st. We'll go into the 28th. So the 18 puts, when this broke the weekly, we'll just make it simple. We'll say they're trading at 32 cents. So if we pay 32 cents on the puts, since we're betting on it going down, we have to be then 32 cents below our strike price to make that break even to start making money. So if the magnitude of T is to go to 17.11, how in the money would that 18 put be? Well, it'd be 90 or 89 cents in the money. So if that option was trading 32 or 33, whatever it was at, and it goes down to here, that'll be worth 90 cents intrinsic, just about. And let's say that happens before your expiration. That's where the theta and the delta and the IV and all that stuff comes into play. Because what it'll do is it'll take the intrinsic value of your option and then add on the other, the other pricing values they use to price options. So if it happens before magnitude, maybe it goes from 32 cents to like $1.20 or something, or $1.10, because it's going to be worth more than the intrinsic value since it still has time left for that stock to move. So when we're calculating that, what we then can also say is, like, let's say this really starts going. Those 18 puts, if this starts cratering in the next couple weeks, we could go to 16 if that really works. And those 18 puts would go from 32 cents to $2. And it's not priced in. So we can look at that, and we can also go even further in strike, because we can say, well, let's go like a month or two out. And you look at the 18 puts, they're trading at 70 cents. So if they're trading 70, and they probably are trading like 60 or something up in here, when this triggers, you can buy that, and you have now more than a month of time for it to try and take this stuff out. If that does not reverse, that's where it's going. So that's the way I look at options, simply because it's much easier to buy things that are not pricing in the move. And then if you get that big move to magnitude, which we're expecting should price not reverse against us, that's when you really get paid. The other thing is, when you're trading options, what's going to happen is, with the strat specifically, you're going to enter. It's going to go down, right? It may consolidate or have smaller triangle out. Like, notice the 2 up, or yeah, the 2 down, 2 up day. So we can consider that triangle out against our winning short position at 17.9, just for example. So when that's occurring, the value of your option is going to be decreasing especially if it's farther out of the money, if you have like a 17 put, because based on the IV and how close it is to going in the money, that option value increases exponentially, which is why people trade options. They move on like an exponential curve as far as the profits curve goes. So when you have an in the money option and it's gone in the money before hitting your magnitude, you'll have a intrinsic value. So you're going to have less drawdown or less theta that disappears from your options when things go sideways. So for example, if we look at next, we'll go to the 28th of June, the 18 puts. You're going to see on the week, they're trading two up, two up, two up. And then when this pulls back on the day and goes 2-2 to the upside, this is still a 1. So notice how this value stays higher. Whereas if you're looking at the 17 puts that far out, notice how they crater back to break even. This is because the 17 put is out of the money with no intrinsic value, meaning it's worth nothing. The only thing you're paying for is the time that it has until it expires. Whereas the 18 put is in the money, thus it has an intrinsic value. So if you can buy it when it's 10 cents in the money, and then it goes 30 cents in the money, it's worth 30 cents, even if it expires that day. So you'll have, let's say, I don't know what T's sitting at right now. So right now it's 35 cents in the money, right? 18 minus 17.64. So if it's 30 something cents in the money, it's worth 45 right now. Why is that the case? Because it still has time on it. So it's always going to be trading above your entry price as long as you have that much intrinsic value. Whereas if it's out of the money, it'll exponentially start going against you and go to 0, which is why options are harder, because you have to be right on direction. You have to be right on when it is going to happen by based on the expiration date. And then it also has to move in that direction quickly. If it slowly goes there, you still might not make money. But if you do it this way, looking at the intrinsic value and how much you have to pay to get that option contract, you can kind of fight that, or I guess at least, what would you say? You can kind of fight that, but just using the logic of if it's in the money, it's worth something, right? Whereas if it's out of the money, it's not worth anything, and that option value is going to go to 0 really quick. So the ideal scenario is like if you can buy it in here at 25, 30 cents, and then it goes 40 cents in the money, you can then have a break even stop because it's in the money 40, 30 cents, whatever it is. So it really shouldn't be coming back to that. And you still have a lot of time on it. So you can let it try and play out. The other thing with options, and since they go to 0, when you get a big move, if you're in here at like 25, 30 cents, and that goes up to 60 cents, 50 cents, you can take off half. And if you do that at 100%, you pay for the rest of your position. So you can let it fly and then go look for new setups while that plays out. So the time value of money is also super important in that sense. And I know we're probably going to have questions, so feel free to ask those in the chat. We do have one question here. How to prevent getting TTO'd? You can't. Wait for the TTO first and then get in. And when I look at my losing trades, either I got TTO'd or holding overnight gaps on me, or the first threes, or the threes first. It goes my way, then it reverses. Unsure what you mean by the threes first. Of course, I have stops, but end up losing. Also with the TTO with tight stops, it gets me out of the position, then rips without me. Re-enter. If you have a daily signal, it triggers, takes you out because you have the tight stop, and then it re-triggers, get back in. It's a daily signal. You probably still have 7 hours left on it. Or, again, depending on what you're doing with the swings, you got a lot of continuity, you can hold that as it draws down, but you need to have a lot of evidence to do that. I would like to see some examples of the gaps against you and what you're trading there, if you could. And while you guys do that, I have an example of exactly this. when it comes to swing trading. So it's not a big position. Don't clown on me for that because I didn't get the 2-2 day ad on it, which is what I said I was waiting for. But for example, GPS. This is just a small position. And it's a winner, so I'm just holding it. Still have all of next week to see if that plays out. We had the 2-2 on a Tuesday with the shooter day. It breaks, I enter, goes instantly, hold. There's a couple other 2-2 days that did not go instantly. I did not hold those. They're like 10%, 12% losses. So in this case, I'm looking at the 27 put, and this was on 6-4. So notice I'm buying multiple weeks of time. Because this 2-2 day occurs on a Tuesday, we have the weekly, and it occurs on the first week of the month. So we also have the monthly continuity. So I'm thinking this trade could be all month. I could have gone an extra week if I wanted to. But once that goes, now I'm comfortable holding overnight. There's no reason I shouldn't. If I went in bigger, which I would have ideally wanted to, is just in the morning I'm throwing a lot of things at the open on Turnaround Tuesday when I am able to do so. When that goes, and that goes instantly and I'm in profit, I'm willing to hold that. I have no reason not to hold that. And you can see it also goes in the money. It's a 27 put. It closes 15 cents in the money after being almost $2 out of the money. Now, if I took this and it did not go right away on Tuesday, that's where I would be less willing to hold at least as much overnight. If it was a bigger position, I would have reduced. So like, let's say I went in with 5 or 10 contracts and it closes just into like 28 or something down in here. I would partial some of that at the close because it reduces my overnight risk. Whereas when it's puking all the way down here, bright red continuity, everything's being reconfirmed, where you're going to see the day, the week is bright red, back into a 3. And then the month is bright red, back into last month's range, failing the highs of the mother bar and reclaiming this at 28.61. I have no reason to get out, even when this is triangling out against me, because there's still nowhere near taking that out. And this is where the ad, I wish I had it. I just missed it in that morning when we were talking about it here. But they go 2 up, 2 down day. This is where I would have ideally got the ad to make these lows back into this 3. And that's what I planned on doing, but as you can see, I did not get it. So the underlying price, yeah. So especially if you're out of the money, even just a little bit, if it's still in force and pops up but stays in force on the day, it can stop you out if you have a break even on the option price. Whereas if this goes deep in profit and now it's in the money, I can put a break even stop on my option because it's already in my favor a lot, and it shouldn't come back to my entry on the option. And you're only going to get that when you're in the money. When you're out of the money, that contract can whip really far. And I want to show you this. For example, on GPS, if I would have gone further out of the money in a closer strike, when this pulls back in, it could be up at this price if it's out of the money. So I have the 21, which is next week. I have the 27 put, which you can see is deep in the money at this point. If we go to, let's say you went far out, you looked at this. You're looking at the 25 put for the daily magnitude. And you're doing the same expiration. You can see if you bought it here, it goes 18 to 60. So huge gain, right? Which is where ideally you reduce position when it's coming back in, and then you 3x your money. You can leave the rest, even if it does come back to here, because you made so much money on that. But notice when it pulls back, see how it goes right back to your break even and then goes again? This is why we want to be in the money, because we have intrinsic value on the 27 put. It stays well above my entry price in here. Because I spent, I think it was 60, not even, it was 50, literally 54 cents. So right on the 2-2 day here. Or actually 50, I think it was 56 cents. So maybe slightly higher. But notice when it comes back in here, it's still trading a buck. I have no reason to get out. In fact, I wanted to add in here. I just did not get it. And then it's back up to 2.5. So you can see in the money, super important. And that allows you to keep the break even once you've made the winning position. The worst thing you can do is create the option position. It goes nowhere. And then hold it overnight. And sometimes it confirms and it works. Good. Other times, problems, especially if you're trading things without long green bars, long red bars, where you have the weekly and monthly participants in force overnight in your direction. Because what a lot of people do is they'll do this. They'll be buying SPY in here. They're like, it's a hammer day. I'm going to buy it and swing it. And then it gaps down. They get screwed. It's like, why does that happen? Well, at that point, you can see this is 6364. This is early in the week. You have no weekly continuity. At that point, the month is very slightly green and inside bar. So you don't have any continuity there. If you're in there and you're saying, well, it's a 3-2 reversal up, I'm going to hold unless it reverses down, that's one thing. But if you're in here and you're grabbing weekly options, when this gap down occurs, you're big problems because you're out of the money and it's not going to work. Whereas if you get the inside day up, when the 15 goes 2-2 in here, which we mentioned on the stream, and you grab, let's say, a 530 or 531 call for a couple weeks out, when this draws down in here, you're still in profit because it's in the money. So hopefully that makes sense. But you can see that goes instantly. You make your money, hold the winning position. Obviously, it chops a little bit, but they go. Shortest DTE. If you're trading on like a Fed day or when SPY's like really bright green, bright red, you got a lot of movement going on. You can do the zero DTE. A lot of people in the Discord, specifically Midnight, Midnight Murderer. I can't quite remember his full. Let me see. It's like Midnight Aptrix. He's not in the boot camp. Let me see. Yeah, the Midnight Murderer. He plays a lot of zero DTE, SPX, and stuff. So you can do that, but you cannot hold losing positions with that. You have to cut it right away. He'll tell you the same thing. So for the three, I mean when it triggers the high, it goes back to the other side. So I loosen my stop, and it hits my stop. And that's why I noticed the hardest part is getting a winning in a winning position. It shouldn't be that hard. If you're trading the actionable setups with full time from continuity, you will create the winning position. Good things happen. So I'd like to see the setups, but yeah, that's why we don't want. That's why we suggest like tighten the stops up, or get on those lower time frames to create the position, because when you widen your stop, what you're allowing yourself to do is take a big loss. Whereas if you keep them tight and just take the signals to reconfirm those higher time frame signals, you will get winning positions eventually, as long as you're doing that correctly. Like when SPY is inside day, inside week, and force, and the 15 breaks, we have no reason to believe that's not going to work. And that's what occurred in here on that day. So you can create that winning position when you have the conditions of these higher time frames breaking in your direction with signals. And then the month is bright green and 2 up at that point. You can hold. You got continuity to do that. And that's why we preach on the tight stops, because threes occur. And since we know they occur, if that 2 starts failing, then unless you have a lot of higher time frame reasoning behind your trade, you got to be very careful. If everything's flat and you have a failed 2 going 3, you might get chopped and they really hurt. And that's the thing. Most people are super scared to trade things that are going with continuity and all that, which is the opposite of how we want to think. We want to think if it's bright green and it's the beginning of the month or the week, that could get a lot greener unless things reverse. Like you want to think of continuity as your backup. Like the monthly is the whole army behind you. And Rob would say like the 60 is the quarterback, like a football analogy. 60 is your quarterback, and then you have your D line, you have your O line, et cetera, and all that. Let me see. So when you're deep in the money, do you let it just expire? No, you wanna close it unless you're trying to get the shares. You can do that too. On the really big, like longer term stuff, like if you're a utility trader from the 322s a couple months ago, you can exercise those, and now you have the shares like $10 lower, and your cost basis is way down there. Break even and invest. And that's the other thing with options that's good is your cost basis is really small, but if you want to get into an investing position and you have the winning position with options, then you're good to go. You have that contract where you can buy the shares way lower based on your strike price. Index, yeah, SPX is cash settles. I'm talking specifically stocks. And I didn't fully answer the question about the days till expiration, what I'm using personally. Um, if it's on a Monday or Tuesday, I'm willing to use weeklies, given that it's a highly volatile name like NVAX or something. We were trading that a couple weeks ago, or even like FSLR. It's even a better example. I'm willing to use weeklies on this stuff. is once this goes bright green Monday, they come back, or actually, wait. Yeah. So they go 2 up Monday, triggering the week, 2 up Tuesday, coming back to buy more. Come Wednesday, I'm willing to go out of the money and play that thing. And in this case, we had this, the simultaneous 15ers on, and it was not here, it was a couple days back. But that's based on continuity. So once they're really aggressive, and you see this, the 2 1 2 measured move in here, you can measure the move and you can say, well, if that works, it's going $16. So you can go $16 out of the money. Perfect. But you need to have the condition of higher time frame signals in force, long green bars, back through previous range. Notice we're not at all-time highs yet. And then the measured move. It all interacts together. You need it all at once. The other thing is when this triggered, it was not at new monthly highs. That was at 232. So even if it went up there, then came back, we'd still have made money, or at the very least break even. Yeah. So with options, like you said, you can get assigned if you hold it into expiration. The reason again, intrinsic value, it's not because we're holding to expiration, it's just to estimate, like, is that move actually priced in? And the rule of thumb with expiration dates is if it's a day trade, go at least 2 days out. So that'd be a weekly contract. If it's a weekly trade, go at least 2 weeks out. If it's a monthly trade, go at least 2 months out. Quarterly trade, go at least 2 quarters out, etc., etc. Because you want to give yourself room to be able to play around with that. Like if it really starts going and you get good continuity, you don't want to close that out until the month ends, right? Which in this case, it looks like, yeah, so you had the last week in here and then the month closed. But if you're just playing like the weekly guy's really aggressive this week, you want to go in with the weekly options, go for it. But you don't hold those if those don't work. This, like when FSLR broke and went, you get to hold it because it's not reversing against you. The first one in there, you either have to reduce or actually get a real break-even stop on your contract because it's a weekly. But at that point, it's in the money and you don't have to worry about the theta and whatnot. Which is like the holy grail of options, is going from out of the money to into money. Yeah, there's another thing you can do. So for those that are on margin accounts, what you can do is, let's say you grab the out of the money. You're looking at like what measured move from here, $15, $16, right? So $16 higher from here puts you at 244. So let's say you're trading the 240s or 245s. Once those go in the money, what you can do to take profit but still leave the position open is leg into a spread, is what it's called. So the 245s, they're probably trading like, almost $1,000, $1,400 at that point. Depending on the day, I can't quite remember. Wednesday, yeah, they're trading like 1,600. So at that point, what you can do is sell higher strikes. You can sell the 255, maybe you sell it for 800 or something. And if you paid like $400 or $500 down here, you just made 300 a contract, however many you bought initially, and then you sold the spread against. What that also allows you to do then is still make more if it keeps going up, but you're protecting your downside risk. So that is one way you can do it. I don't find myself doing that as often as I had done before, but that is one way you can do it. The other thing is when you get mother bars, you can sell options in those mother bars. So like Boeing, just an example of a mother bar. When this goes inside here like this, we pretty much know that's it's probably not getting out that for a while, right? So you can sell the strikes higher and lower in here, expecting that they're going sideways. There's also other strategies you can do to make money when the market goes sideways, but those are a little more advanced. I don't personally throw those on myself, but a lot of people do sell options. Yeah, so ideally double the length of your signal for when you're picking the strikes. If you're straight up just you trade week to week and you're trading weekly signals, you can go with the weekly options, but what we'd prefer to do, like for example Boeing, when this 312 week triggers, trade next week's options. Give yourself some time. Once it starts gunning and it's up $2, $3, $4, then you can go after the 190 strikes that are out of the money. Since you already have their money, you can risk their money in the out of the money options that are more risky. And that was an example of what we did with the OIH trade, which we had already talked about. But OIH was this, the monthly inside bar PMG. Once this goes 303 to 314, I'm looking at the 340 strikes because they're super cheap. And if that keeps gunning, into the next month, which it did, grabbed a couple like next month, I think it was 5 weeks to expiration. Those will go really far, and I don't have to risk as much money. And it's a little bit expensive. XLE is another one. You can see it's like once that starts going, bright green month, it gets greener, right? So we can take, say our magnitude's 93.72 and buy the 92 strikes after buying maybe the 88 strikes down at the monthly break at 86.86. So you get that in the moneyness, get your intrinsic value, and then you can say, well, okay, I've got 5 contracts, $3 of intrinsic value each. That's $1,500. I'm going to throw 500, $600 into out of money options that expire in 2 weeks, end of the month or something. And then if those go $1 in the money, maybe they go 30 cents to $1, and you just made even more. But you're risking their money, not yours. It's the big, big thing that has to be followed. And I can probably actually pull that up and show you guys. I have to go into my stuff. Just give me a sec here. How many months ago is that? 1, 2, 3, 4. I actually sold them in here. Let's see. For some reason, oh, it was in April. It was April. It was just outside the date range. Here we go. You see, they're sold at 9. That was the April 24. Bought at 256. So it's like what 3x 300% ish. I think they hit a high of like 470% or something, but I wasn't there to capture that fully. But an example of that, and this was I created the position, reduced a little bit of it, and then took the last 2 off up there. There isn't much next stuff to get onto besides, yeah, let's get into it. And I apologize, I don't have, and this is just Discord etiquette. So we already went through the struggles and stuff, but I will copy and paste it, throw it in the chat. And we'll probably, yeah, so here it is. We could probably pin this into the premium chat. Before we chat about it here, so the Discord etiquette, what we want is we want people to speak in only what you know to be true. If you're in the premium chat during the day or in the weekend, whenever you're looking at setups, we don't care if something is, hey, that's going up, or hey, that's going down. What we want to know about is give us the actionable signal. This has a magnitude to what? Which participation groups are in control? Is there an additional signal that's setting up that we want to know about on the next 60 or the next day, the next week, the next month, etc.? And we only want to talk about what we know to be true. So everything we've talked about, we should be able to, as stratters, open a chart and know exactly what we're looking at. It's like OIH. Pre-market on 613, if you're talking about OIH, you would not say OIH looks like it's going to go down. You would say OIH is setting up the 122 rev strat, and it has a magnitude of like, what, $7. And then you say that, and everyone's like, oh, that sounds good. And then you can also say, if that works, it would negate the week and confirm the 2 down month. So speaking only what we then know to be true about current price. And then in the morning, you can say OIH goes outside 5, setting up for a 3-2 continuation. And then it does. The next fiver to the end of the 15er. You can also say it sets up the 1-3-2 expansion. Does that as well. So we want to know what we know to be true. We do not want this is going up, this is going down. This looks good, this looks bad. We know what that is. So define it, speak it as if you know what you're talking about. So, and you should, right? You just did the whole course. So we want you to talk like a stratter. And that's why the strat's so good, because you can say OIH rev strat day, magnitude X dollars would negate the week. And everyone that trades the strat without looking at the chart knows exactly what you're talking about. So stick to that. And if you waver or wander from that, you'll get confused, and you'll also confuse other people, because if you just say this is going down, is it into exhaustion risk? Does it have a magnitude? Is it an inside month? What's going on? We don't know what that means. So speak in what we know to be true. The other thing is during the day or over the weekend, throughout the month, whatever you're doing, if you're unsure, ask about the setup you're looking to take, and we're here to help. Because not only do me and Sarah know the strat, but everyone who's taken this course should know what you're looking at. So if you're saying, I want to go trade OIH 122 day, and let's say it's deep inside month, super inside week, and doing nothing, inside quarter, inside year, all of that, other people can say that and be like, hey, like, dude, that's stuck inside on everything. Be careful, or like, we'll call you off that and say, don't do that. And not only can me and Sarah help you, but everyone that trades the strat, because we know what we're looking at. And we know that an inside and down looks good, right? But trading during this inside week, really bad. So we're here to help. The other thing is, if you see a setup, point it out. If you look at it and you're like, wow, this is a shooter week with the PMG, this looks great, post about it. Tell us. Because the more people we have scanning the market and that know the strat, the better all the stratters can do. Because if you're scanning, I'm scanning, Sarah's scanning, and then Timmy, Tammy, John, and Lewis are all scanning, we can find a lot more, right? Especially based on what universe you're doing. If you are a quarterly, monthly, yearly guy, you might find something that we're not on because we're not looking at those charts quite as often. So you'll help us, and then we can help you. And what we say is, the more eyes and keyboards we have, the more we can all make, because there's so much possibility, like we said, with the universes. It's endless, right? So if we have people that know the strat, know what they're talking about, we can all make more, and we'll see more setups, get more trades. And if we're doing the correct thing with continuity and reversals, those trades on average will do good. And the example here is like, I have 4 screens. If Sally has 2 and Jim has 3, we now have 7, so we can find more trades. And we obviously have hundreds of people here, so we should be able to cover a lot of the market. And some people trade crypto. Some people are going to be trading indexes. Some are going to be trading futures, all that stuff. Like if you open the futures overnight and you're looking at IWM, there's a great futures broad information, post it, right? We want to see it. As long as you're talking in what we know to be true. And we can also then help you, because if you're posting your stuff and you're not scared to post it, which you shouldn't be, if you're doing something wrong, we can help you out. So all of that super, super important for Discord. And this is pretty much the end of what we had scheduled. You're obviously going to be here for a couple more weeks, so we'll have the weekend vid out, and that's where we're going to talk about potential setups into next week. A lot of the inside weeks broke, and my weekend vid out prior weekend, but we'll be sure to get that done. Normally they come out Sunday night, and over the weekend, given what you know to be true, what we'd like to see is a lot of scans. If you can post in the premium chat, post some rev strats, inside bars, hammer shooters on the weekly basis, maybe whatever monthly signals are in force that look good. Anything you find, post it. We want to see it. And that'll make you better, and it'll help everyone else out. So that is the little Discord etiquette section. And that pretty much covers the whole entire course. So yeah, do not be afraid to ask questions, just like Tim said. Yeah, a lot of people blurt out tickers. They'll just be like, NVIDIA. It's like, that doesn't help. You got to say NVIDIA something. Don't you have 9? No, I do have 4 monitors. I do have an ultra wide though. So my ultra wide display, I don't know if OBS will show the whole thing, but my ultra wide is like pretty much 2 of the screens I have. So I can have this up and this up on my other screen at the same time. And this is really cluttered in here, but on my ultra wide, it looks great. And like, for example, so what we mean by calling stuff out. Intraday, especially, since we only have 60 minutes to find setups, sometimes there's 40 inside bars on the inside 60 list. So it's hard to filter through that, especially since our scanner on the Strat site doesn't allow us to filter for higher time frame 2s and stuff yet with inside bars. So like, for example, with that, if I'm in the stream and I'm like, hey, there's like 60 inside bars, help me go through the list because it'll help all of us, right? And if we have, a dozen people going through it, someone starts at the top and the bottom and the middle, we'll get through it in no time, 5 minutes flat, and then we'll have an extra 5 minutes to prepare for the next flip. So like that, for example, or each night you have the nightly signals, you get all night to try and figure out what's going on the next day, or at least what's setting up and looks good. So that is that. Yeah. So the only other thing we really have tonight, obviously we've been going on for a while, but we'd like you to write down your trade plan. And if everyone can post it in BootCamp homework, that's what we want to see. And it needs to be, what signals are you trading? What time frames are you trading? And maybe is it sector specific breaks, simultaneous breaks? Is it, I'm just going to trade rev strats 2-2s on a Tuesday? Like, what are you doing? And that is the homework tonight. And we can then next week go through that. And over the weekend, hopefully on Sunday, spend some time, if you can post your chart setups into next week, what you're looking at, and say, this is my trade plan. Does this align with that? We can then make sure you guys are lining that stuff up. Yeah, we're glad to have you. Awesome. So again, tonight's homework is your trade plan. I'll make sure to get that posted. So you got that. And then over the weekend, your homework is to scan for your trade plan. If you're trading inside bars and rev strats, scan for those on the week, see what you come up with, and post them I think honestly post them in boot camp homework and say like my trade plan is trading 1-2-2s and inside bar breaks. These are my setups into next week. What do you guys think? And we will get to those and take a look. And on my weekend video, if there's anything that you guys pick out that looks really good, I'll shout you out and we'll do it like so. So I hope you guys have a really good rest of your weekend, and that will be it. Adios. I'll see you guys next week.